There are two ways to report a company's financials: a cash basis and an accrual basis. Cash basis accounting simply means you only report the sales for the jobs that you have been paid for, and you only report expenses if they have actually been paid. Accrual basis accounting means that you report the sales and expenses at the same time they are created, but you set up balance sheet accounts such as accounts receivable and accounts payable to reflect what is owed to the company by customers who have not paid yet, and for what the company owes suppliers who you have not paid. The accrual basis is far better for management purposes because it matches the exact expenses for the month with the exact revenues that were earned. Unless you choose otherwise, your control panel is set up on an accrual basis. This will give you a far better insight into what you can expect your future cash flows to be. Starting at the top, we see that we have the opportunity to expand or collapse the actual columns just as we had on the Budget versus Actual tab. We can do that individually with these little boxes with the plus or minus signs, or we can do it all at once with these boxes in the left-hand corner with the number 1 or number 2. The cash flow forecast column and the actual cash flow column will always start with the actual cash balance that you began the year with. In this case, it is $50,000. We will now move down through a single month to show you what impacts the cash and how it impacts it. As we go down through the month, we will also compare the budget versus actual. First, we see net income. This is the operating profit or loss for the month. You can see here that the business owner anticipated a $23,000 profit, and you can see instead a $12,000 actual profit. Depreciation and amortization are non-cash expenses. Depreciation is how you expense large physical asset purchases over time that the IRS will not allow you to expense all at once. These are things such as land, buildings, or equipment. Amortization is for purchases such as software that do not wear out over time, as physical assets might, but still cost too much to expense all at once. You don't write a check for depreciation or amortization, even though they show up on your P&L and budget as expenses. Therefore, they do not impact cash. But since these expenses lower your net income on your P&L and budget, we must add these expenses back in to get a true reflection of your cash flow. We now see that your net income plus your depreciation and amortization equals your total operating cash. Accounts receivable can have a large impact on cash. This company had an accounts receivable balance at the end of last month of $50,000. At the end of this month, it had grown to $60,000. This means the company earned $10,000 that it has not been paid for. But we wouldn't know this by looking at his net income. We might easily assume that everything that was earned has already been paid for. But we know that is not the case because his accounts receivable balance is $10,000 higher this month than it was at the end of last month. Therefore, we must deduct $10,000 from his net income, because even though it was earned, it has not been collected. If the opposite is true next month, and his accounts receivables goes from $60,000 to $50,000, then the result was we would have to add $10,000 more to his income, because $10,000 more would have come into the company than was reflected on his net income line. The same principle is at work with your accounts payable. Once again, your P&L's net income reflects the expenses that are created in the month, but you may not have actually paid for them. If you accrue an expense because you did not pay for it yet, your total operating cash will be overstated by the amount of that expense because your P&L's net income reflects the expense that you did not pay for. So we do for your accounts payable what we did for your accounts receivable. When your accounts payable amount increases over last month's amount, we know that you didn't pay for all of the expenses that reduced your net income, so we add back the difference to your cash. When your accounts payable is less than last month, we know that you paid for more expenses during the month than are reflected by your net income, so we deduct that amount from your cash. While these additions and subtractions for payables and receivables may seem confusing at first, once you work through your control panel a few times, the logic will become increasingly clear. On the BS tab, we have a separate line item for your payments on your credit cards. This allows you to reflect a faster payoff or buildup of your credit card debt separately. This was also discussed on the Balance Sheet tab video. The actual column will reflect when you pay down your credit cards with a negative number, And if your credit card balances are increasing, this will be a positive number, since your debt increases and you are keeping your cash. The inventory, which this company does not have, was similar to your accounts receivable, in that when your inventory is increasing, it is consuming cash as you buy it, which produces a negative balance. And when your inventory is decreasing, it is freeing up cash as you sell it, which produces a positive balance. A change in prepaid accounts, deposits and payroll, and other items on your balance sheet will be reflected here. These are also areas where cash can be tied up or freed up throughout the course of a month, just as in the previous topics. Funded debt principal repayments are the principal portions of your loan payments that are not reflected on your P&L or budget. As we discussed on the Balance Sheet tab video, principal payments are not expenses to the company since you're just paying back a loan. Otherwise, you could take out a big loan and immediately pay it back and reduce your taxable income each year to zero. Only the interest portion of a loan payment is an expense. As you can see here, this person's principal payments have a $3,000 impact on his cash balance. Capital purchases are those large purchases that cannot be expensed in a single month and must be depreciated over time. But when the purchase was made is when it impacted the company's cash. As you can see here on the Balance Sheet tab, there were no purchases expected or actually made this month. Sometimes, and usually only in January, there is a discrepancy between what the cash flow statement shows in the available cash balance at the bottom of the report and what you might actually have on your balance sheet. This is a common experience when a CPA or accountant makes year-end adjustments in the previous year for a cleanup or for tax purposes. When this happens, it might create a discrepancy in the January's cash flow statement. If there is a discrepancy, it will show up on row 30 of your cash flow tab. Row 30 is just a check to make sure your cash flow statement balances with your actual cash balance. If there is a number here, we simply type the opposite of that number into the adjustment cell, so we get a 0 on row 30. Here we have a negative $1,000 discrepancy, which could have been created from any number of adjustments in the previous year. Rather than going back into the previous year, which will have no impact on our planning for this year, we simply put a positive $1,000 balance in this adjustment row. Doing this makes sure that the cash balance of subsequent months balances with your actual balance sheet. Your ending cash balance before investment or withdrawal is what is left over after all of the above additions and subtractions have been made. If this number is negative, then you must decide how to make it positive. As you can see, there are only 2 tan cells in each month in this tab. These cells are for identifying if the business owner will put cash into the company or if the business owner will take cash out of the company. If the ending cash balance is negative, cash must be put into the company so it can continue to operate. This can come from a line of credit or any other source of cash the business owner might have access to. It is recommended to have a good cushion of accessible cash above what the ending balance here would indicate that you will need. A great value of your cash flow tab is to plan in advance your cash flow needs. You do not want to be scrambling at the last minute to cover your payroll or a bill when your cash flow tab could have shown you months in advance what your needs were going to be. The next tan cell has room for a more positive input. This is the place where the business owner can budget to take cash from the business in the form of a dividend. Dividends are opportunities that the IRS offers business owners to take money out of their companies in a more tax advantageous way. If you have cash accumulating, you can budget here to take money out in a lump sum, or you may prefer to plan for a regular monthly withdrawal, as he has chosen to do here. Consult with your CPA for more information if you can take dividends in your situation. Finally, we have the ending cash after investment and withdrawal. This is the bottom line when it comes to cash flow. As you grow increasingly familiar with the things that impact your company's cash, you can then begin to control these things with a new level of confidence. Few things are more exciting in business than accumulating cash. One of the goals of your control panel and your trainer will be to make that happen sooner rather than later.